Hey guys, what's up? Did a little sparring today at the boxing gym. It's always good, man. Like Mike Tyson said, everybody's got a plan until they get punched in the mouth. And it's great therapy to get punched in the face. I'll tell you, man. Everybody should fight. Fighting solves everything. It calms you down, it gives you some perspective. And sometimes what we do, in the markets can feel like a fight. We shouldn't let it get to that level. I mean, there's fighting, like in a boxing ring or jiu-jitsu or whatever. I think investing should be more like Zen, calm, detached. Anyway, let's talk about today. Today was another day of Powell testimony, and he made a statement today which I think was the reason behind at least most of the rally until late in the afternoon, when it was like a melt up. I don't like, you know how I feel about language. I don't like to use language that is figurative or embellishes or is hyperbolic or highly emotional. So it's rare for me that you're gonna hear me say something like it was a melt up. Like, I never say the market crashed, I never say the market tanked. I don't use those terms, but today at the end, it was definitely at the very least some kind of a short squeeze, because we were moving higher through most of the day. And I think that came off of Powell's comment that he said, well, the Fed's not going to wait until 2% inflation, because if it waits, it's going to be too late. So it's going to cut before. So of course, you guys understand that 99.9%, I just call it 100%, look at the markets through the lens of monetarism, which they don't really understand. And I guarantee you, this is an ironclad guarantee, I will write it down, I will sign it, that once the Fed starts cutting rates, and we already have an economic growth scenario here, or economic growth is like 1.5% so far this year. When the Fed starts cutting rates, we're going to go flat. We may even go negative on growth, okay? Because that is going to be the opposite of what has happened with the rate increases, where the rate increases resulted in historic interest income transfers into the economy. Once the Fed starts cutting rates, on the belief that, that's going to stabilize the economy. If it's slowing down, that's going to take care of any sort of rise in unemployment or joblessness. It's actually going to create the opposite, for the very reason that we had this big boom when rates were increased, because it's going to remove those interest income transfers. Anyway, you guys know this. I've been telling you this like almost on a daily basis. So getting back to today, a lot of what we saw through, I would say, most of the day, up until the last half an hour, maybe up until the last 15 minutes, was just this buying based on a more bullish outlook, at least from a monetarist perspective. I should mention that there is still a very large short position in S&P futures held by the large speculative funds, okay? They're called leveraged funds. You get that number on the CFTC's Commitment of Traders report that comes out every Friday. And I do a whole breakdown on that and analysis on that in my MMT Trader report that I send out. But the large spec funds have been short this market, basically for 2 years. And they still have a large short position in the market. On the other side of that, you have institutional asset managers who have, it's not a record long position, but it's close to a record long position in S&P E-mini futures. So there's a lot of short covering that could still happen there. I know a lot of people look at this rally and it's like, it just can't be. It just can't be. And in a sense, I was one of them saying that the economy is slowing down and the market is going to follow the economy. And I stick by that. I abide by that. But I did a whole thing the other day saying, that saying from the Jesse Livermore book, the market always tells the truth. Yes, it always tells the truth, but it doesn't always tell the truth on an instant. We will have, the market will reflect the slowdown in economic growth. Right now, that slowdown is being viewed again by the monetarist cohort as something positive. Like I even read several internet posts where pundits or analysts were saying, oh, the economy's slowing down. That's really good for the market. It's good in their minds because for them it equates to lower interest rates. And because they use single variable analysis, in other words, they only consider one side of the impact of lower interest rates, which is relief to debtors, they never consider the other side. Remember, it's double entry accounting. That's what we do. For every credit, there's a debit. For every asset, there's a liability. For every borrower, there's a lender. On the other side of that, again, it's removing those interest income transfers, and that is going to be a significant thing, particularly now that the economy is growing at a relatively slow rate of 1.4%. I mean, once they start cutting rates, you could see unemployment jump up pretty rapidly. So if we're looking for a catalyst for some kind of a market correction, and by the way, this market correction, when it happens, this is not going to be like a few weeks. I mean, this is if it comes from the Fed starting to cut interest rates, this would be a fundamental change in the paradigm that we've been in for the past 2.5 years. Okay, the past 2.5 years, we've had rate hikes and then rates being held at high levels, which resulted in these ongoing interest income transfers. Once you reverse that paradigm, once you reverse that dynamic, where now monetary policy is literally siphoning off interest income, then you're talking about a complete change in the fundamentals. Not a complete, but a very important change in the fundamentals. You're still going to have fiscal that is related to normal government spending. But what we have seen over the past 2 years, 2.5 years, is that the fiscal has been pumped up by what the Fed has been doing through monetary policy with raising interest rates, which necessitated higher interest income transfers by the Treasury, by the government into the economy. And also the Fed paying interest on reserves to the big banks. By the way, the big banks have been a spectacular investment. They're lagging the market right now. But I keep telling people, like, when you see the market shooting up every single day, I mean, don't chase. Go after things that are lagging, especially if they are high quality assets. I mean, you're talking about JP Morgan lagging. That's a high quality asset. It's the biggest bank in the United States, one of the biggest in the world. You're talking about Wells Fargo. You're talking about Citigroup. You're talking about Bank of America. You're talking about Goldman Sachs. I mean, those stocks have been lagging. People are chasing it. I had somebody said to me, I can't believe people are buying. And I said, you know what? Believe it, because it's almost like you wouldn't believe how many people are buying, chasing after the hot names when they see a market like this. It's the same exact thing when the market goes down and they panic and they sell out. I think it's even more intense, believe it or not. I mean, it's scarier to most people. It's an interesting dichotomy of emotion. I mean, when it goes down, that instills like really high levels of fear in people. And they dump, and they dump. And that's when you want to step up, and that's when you want to buy. On the other hand, when it's going up like this, it's a kind of a panic, but it's not a panic that comes out of fear. It's a panic like you're missing out, right? FOMO, fear of missing out. It's this gnawing, aching feeling like I gotta get in, I gotta get in. Like you feel left out of the party. Okay, it's like there's this incredible party going on. And all the famous and all the elites are there, you know, and all the A-lists are there. And you're on the outside. And you want to get in so bad, you can taste it. That's the kind of emotion that it conjures up in people, and they can't hold back. I mean, you know, it's impossible for them to hold back, and they jump in. I used to do this so many times in the early days of my career and I've spoken about it many times. I was a good analyst, and I'd get in and I'd take a little profit, and then I'd see the thing continue to go and go, and then I'm like, what the hell did I do? I should have stayed in. Then I jump, I chase after it, I run in, then I buy at the top, then it comes down, then I puke it out, then it goes back up the way I thought, and then I jump back in, and it was this constant whipsaw, whipsaw, whipsaw. So for now, it's not really a whipsaw because it's going up every single day. So these people are getting rewarded, and it's like it's compounding. Like every day, there's a new strata of investors who jump in who didn't buy the day before and who didn't buy the day before that. And tomorrow there's going to be a new strata. And every strata that builds on top of the prior layer, it's weaker and weaker hands, okay? It's kind of like building a house of cards. And at some point it topples over. But I tell you that the way it's going to topple over, and it's not going to be like a mere correction. It's going to be a complete change in the paradigm when it happens, and that's going to be when the Fed starts cutting interest rates. And remember, you heard it here first. Nobody's telling you this stuff, man. Nobody is telling you this stuff. You heard it here first. So anyway, be patient. This is actually a very, very good environment because, you know, it's not, this whole game that we're in, this whole endeavor of investing and building wealth, it also has to, it's not just about picking stocks. It's not just about figuring out what the market is going to do. It's not just about understanding economics. And I've said this so many times. It's about you. It's about personal behavior. So much of this and so much the part of success, it's about how you act, how you behave. And when you have a situation like this right now where it's going up every single day and you're not in it, and you say, damn, I missed out. You didn't miss out because there's a whole other aspect. The market is giving you, this environment is giving you an opportunity to train. Like I talked about my boxing today. I train every single day, okay? This is an opportunity to train the mental game, the discipline, the patience. I mean, you could look at this and just see the market going up and say, I missed this gigantic opportunity and, oh, woe is me and it's terrible and I could have made this, I could have made this much. You could look at it that way and I'm such a loser and why didn't I get in? Or you could look at it, okay, I'm not in right now, but I have a great opportunity to work on my self-control, on my discipline. There's other things I could look at. I gave you names right now that are lagging in this market that nobody's paying attention to. What are they paying attention to? The tech stocks. You know, they're paying attention to NVIDIA. They're paying attention to Apple, stuff like that. There's thousands and thousands of stocks. I told you about home builders. They've been bouncing back nice. I told you about energy. Okay? So there's plenty to do here. And maybe it's not necessarily involved with being in the market. It maybe just has to do with being involved with taking care of yourself, managing yourself, using this to build up. Like this is like going to the gym and working out or getting in that ring and sparring with somebody really tough. All right? I mean, there's other ways you can look at it rather than, oh, woe is me, I'm not in the market. Oh, I suck. No, you don't. There's other things you can do. Take advantage of it. There's always something else you can do. And that, that comes back to, you got to always keep working on yourself. Whether that's what I'm talking about now with the mental game and the mental discipline, physically working on yourself, challenging yourself all the time, seeing things a different way, okay? It's just as easy to see this as an opportunity as it is to see it as, a lost opportunity. I mean, it costs you the same either way, at least emotionally, okay? It's a decision. That's all it is. It's a decision. And if you say, oh, Mike, I feel terrible that I'm not in. Well, you could say to yourself, I feel great that I have this opportunity to work on having some perspective, playing the long game, having some patience. These are more valuable attributes than being in the market right now, believe me. Because whatever's happening in the market right now, I can guarantee you that the people jumping in right now, that money is going to be given back at some point. So take advantage of this. Look at it from a different perspective. Use it as something of value, because that's what it is. Okay? You have a choice the way you see things. You could see things as negative. You know the old saying, I got lemons and I made lemonade. Which in fact I did today. Not lemonade, I made some lemon sorbet. Anyway, that was weird little diversion there. But anyway, you know what I'm talking about. That's it for today, folks. Please like and subscribe. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.